So Professor Sridhar Das would be speaking on economics and enterprise development, a practitioner's perspective. Over to you, sir.
Good evening, everybody. Can you hear?
Yes, sir. Yes.
And thank you, Odisha Economic Association, for giving me this opportunity to share few thoughts. And it is also a great honor to present this lecture as a memorial lecture for Baidyanath Misra, who also, when we were students, he was a famous personality. So he was also the inspiration for many of us. We also studied economics. I was a economics student in SCS college. So I had a lot of inspiration to get from Professor Misra. As far as the flowery introduction made by Professor Amarendra, let me tell you that I did work in industry. Most of my work involved uh, reasonably mathematically complex modeling, and I was doing what we call estimating probability of default for anybody who takes loan. So since uh, Professor Amarendra get in touch with me, I was thinking, what should I say? I had an option to present a paper which I have wrote with my PhD students, and or I could give a broader thought on combining my industry and academic experience, and then probably that will give a better perspective. And so I choose the latter. So now, given what I have proposed, I have two components. One is extremely macro components, and the other is extremely micro components. I will try to link it with my training in economics. And of course, I love history. So, from a history and economic perspective, let me give you my thoughts. And it is not necessarily originated from my brain, it is coming from all my readings, interaction with my colleagues, interaction with my students, and so it's not necessarily my thoughts. It is a thought which originates from many others' thoughts. I'm just assimilating and presenting it in front of you. So since the topic is extremely broad, I would like to set the context. So let me share the presentation. Can you see?
Yes, it is coming, sir. Coming. Yes. You may put it on full screen.
That's what I'm trying to do.
Okay.
Can you see?
Okay. The full screen is not yet coming.
I
So,
have
so then you can escape the full screen option and then continue the presentation. But it is visible to us. It is visible to us. Sometimes because of the browser, sometimes the full screen option doesn't work. So
no, that is, I am having a bigger problem now. I am not able to change the slides. It got hanged.
oh, okay, okay. Yeah, it is changing. Yes.
Yes. I have to go to original and to change it. Okay. So, so let me set the context so that at least the topic is broad, so we can narrow a little bit, so that we can take away something from this lecture. So, what the context is effectively, if there is an enterprise, if that enterprise does well, who will benefit? We can always say that the maximum benefit will go to owner's capital. So, and given that, because owner's equity has the residual claim on whatever corporation makes, that's the maximum beneficiary. But if the enterprise suffer or goes bankrupt, then who will suffer? The maximum suffer will come from employees, vendors, societies, and communities. So if that is the case, uh, uh, when we are talking about enterprises, what should be our focus? So again, I am said, since most of the suffering will come through the employees, so I'm coming to, let's say, labor market. So I'm bringing some paradoxes which you can see if you look at anecdotal evidences, conversations of CEOs of various companies and industry leaders. They're all saying that I'm not getting the right kind of skill. And but we also know that there are large number of people who are looking for job. So if that is the case, why that is the case? There are many people who have pointed out many things about education system, but I'm just highlighting what I have observed. The next one is actually a paradox. If you really think through this, uh, uh, because I work in an management institutions, I see it every day. So what it is employees. That means the people who are looking for job are ready to pay for the job. That means if I am going through a professional education, I am ready to pay a very high fee because my institution is providing an opportunity to participate in placement process. And in if the college or institutions or universities have a placement track record, so the institutions can um, charge high fee and students will be happy to pay, but they are not ready to pay for their education. For example, any university who is providing any education and but not providing placement opportunities, then the fee structures will be very, very different. So, however, if you look at from a corporation's point of view, employers are ready to pay for the skill. Means if you have certain skills, they will pay you a good salary, but they are not ready to pay for the education. So if this paradox needs to be resolved in some way or other, otherwise we will have this perpetual we have large number of mm, people who are looking for job, and corporates are complaining that we do not have enough people, skilled people to recruit. And currently, in political economic discourse, employment and unemployment problems in India is quite large, and transferring informal employment to formal employment. So there is a visualization that if a enterprise is growing, they will recruit more people, and if we create new enterprises, we will have more people to hire, and then probably we will someday solve our employment problem. Another context is another factors of production market or capital markets. So we have a vibrant public equity market. Underlying word is public, because our market is ranked probably within top 5 public market. The trading volume is quite large. It's a very liquid market, highly vibrant market. So anybody who wants to raise capital for any enterprises in public equity market, it's reasonably easy to do so. But there is lack of private equity market. Major private capital, when I say private capital, I mean there are enterprises who are closely held. They are not public companies, they are private companies. So those private company also need capital to grow. And where will they get that capital? So the local private equity market is mostly dominated by foreigners, and local wealthy entrepreneurs, businessmen, companies, even endowments, foundations, they are not necessarily participating in private equity market, including insurance companies, pension funds. So in some sense, Indian private equity market is not very vibrant with respect to local capitalist participating in that process. So, however, Indian institutions and family offices are starting to participate recently. The more importantly, we also have a shallow debt market. That means if anybody needs credit, the banking system is the dominant system which will provide you the credit. But as you would know, banking is a regulated industry, and the capital adequacy ratio will be very high. And in that some sense, it's a intensely capital intensive industry. That means we need that kind of capital to support the growth of industries. So if you look at developed markets, debt market is quite vibrant. In fact, debt market is bigger than equity market in many developed countries. However, unfortunately, our debt market is not that well developed. Even if the corporations are raising money through bonds, which is effectively going to public to raise money, they are not listing those bonds in market, so liquidity is not good. So to summarize, that equity market is vibrant, but the debt market is shallow. And of course, our regulators, policy holders are making every attempt to make this market liquid, vibrant, so that our banking system can actually will not need that kind of equity capital to fund the future growth. Another big problem because of lack of debt market is with respect to asset liability management. For example, most of the liability of the banks are on an average 3 to 4 years. Suppose, just think of it. If you go to any bank and say that I want to have a FD for 15 years, bank will say, sorry, we don't have that product. But if I'm building an airport and I need money for 20 years, I will go to bank, and bank will say, I don't have that kind of money which has a liability base of 15 years. So in some sense, if I'm looking to borrow for a very long period of time, bank will face a significant asset liability mismatch. That means they are raising money from public for short term, and they will give loan for long term. So when you are investing risky asset like any project which has a long gestation period projects, this will be extremely difficult for to fund. And that's why even government has created institutions, financial institutions, who would actually fund this kind of long gestation projects. if you look at another aspect, because I am focusing on labor market, capital markets, and if you look at the capital need, if the conventional macroeconomic theory will say that incremental capital output ratio, and then depending on our saving rate, will define a possible growth rate. I'm not saying that if you have saving, it will grow. We have studied in the foundational macroeconomics, saving is equal to investment. And if I have an incremental capital output ratio of 4:1, which is India's incremental capital output ratio, is then I would probably need 32% saving to achieve 8% growth target, which is the target which we want to become a Vikasit Bharat. And to complicate the problem, in Indian context, savings are in physical assets. We buy a lot of gold, we invest in land, we invest in houses, multiple houses, and but what we need is that money should come to capital markets for us to invest in developing enterprises. However, in recently, especially post-pandemic era, there is a culture of financialization which is emerging, and our digital transformation is helping us to bring the money to banking system. Hopefully, we will have a large financial savings which will fuel our growth. And given that we have a high incremental capital output ratio, and our savings are most lot of savings goes to physical assets, there is a gap. What is needed and what we have. So keeping that in mind, we need a lot of money from foreign savers. So that is why foreign direct investment or foreign portfolio investment is critical for our economic prosperity, because we are a capital deficit country. So see, this is the context on which I will look at the enterprises. Now, if you see from a perspective of an entrepreneur who is thinking of starting a business or an existing enterprise, is thinking it to diversify. Economic provides a conceptual theories which is in the beginning two competing thoughts, rather economic philosophy, because both of them were more philosophers than economics, because we call them economics because that's what they define the subject. One is very well known, Adam Smith. The other is not necessarily taught in conventional economic courses, but I am a fan of his thoughts, J.B. Sage. So I am talking about two classical old economic philosophers, Adam Smith and J.B. Sage. If you really think of their ideas, Adam Smith says demand creates its own supply. It's effectively, if an enterprise wants to start anything, he is looking for what will people need, what will people demand, and then start producing that. On the other hand, JV says just the reverse. Says supply creates its own demand. That means if you really want to sell something, just produce, and the people will buy it. But in logical sense, it may not appeal to many conventional economists or conventional business people. However, if you bring the concept of management and superimpose these two thoughts, which I have shown in this 2x2 matrix, if you say that any business will have product and services, and business also will have will face markets. If you see, and there are markets are existing and markets are new. And similarly, product and services are existing and product and services are new. So if you really think of it, this is my argument that if you are looking to produce an existing product within an existing market, and then you are actually following Adam Smith's principle. For example, there was a restaurant who was selling Chinese food, and a lot of rush happens in that restaurant. Somebody went to the restaurant, has to wait a long period of time to get into the restaurant, and then he suddenly says there is a huge demand of Chinese food in this town, so can I actually open another Chinese restaurant? So that effectively means he is using the same thing in the same market. So that's fundamentally Adam Smith's principles. In same way, if you visualize that we have an existing product, like Odisha has a very famous product called Chenapoda. So if you think that the Chenapoda is quite unique, and if you take Chenapoda to your friends who are non-Odias and living outside Odisha, they will be happy to consume it. If you visualize that and say that, oh, I can take this Chenapoda, let's say, to Bangalore and sell it, then it will be the existing product, but you are offering it in a new market. So in some sense, it is like following a little bit of Adam Smith, more of Adam Smith and little bit of JV says, because there is a demand for this product, but there was no supply. So you supply, it will be consumed. But the caveat here is, for example, when we are talking about Chinese food in India, it is actually Indian Chinese. That means this food is spicy. So the real Chinese food who does not have a lot of spices may not work in Indian market. So that means the person who introduced Chinese food in India actually took that into consideration and did little bit of innovation to suit the taste bud of Indian consumers. So that's why that blocks, which I call quadrant B, is more of Adam Smith, little bit of JV says. And if you come down to quadrant C, which is the market is existing, but the product is new. For example, I'm introducing electric vehicle in the market, or ITC is introducing millet biscuits. So the market is same, you are bringing a new product into the market. There, you are actually following more of JV says, little bit of Adam Smith, because what you are producing has to have a demand, but it has to be innovative. So it's combination of JV says and Adam Smith. But if you go to the quadrant D, which in business we call suicidal quadrant. So in some sense, that is the highest risk because nothing is known. And business professionals also call it blue ocean strategy. Correct? There is no competition. For example, when WhatsApp came into existence, or Uber came into existence, or Airbnb came into existence. So those are disruptions in the market, which you just expand the market, nothing existed, and you just created it. And to be operating in that quadrant, there is a philosophical understanding that we don't know what we want. If you take that concept that we don't know what we want, if somebody can visualize that we may want this, then and through trial and error method, if you succeed, the payoffs could be significantly higher for the entrepreneur. So if you really look at this quadrant A, B, C, D, conventional businesses will migrate from A to B, B to C, and C to D. And then new enterprises can start anywhere. However, the enterprises who starts in quadrant C and D will have a significantly larger opportunities and will start and then potential to grow big. So, and when I put this in a very oversimplified 2 by 2 matrix, uh, there are many extensions possible. uh, when I was visualizing this, I was visualizing in the context of India. But since you want to produce something and if you want to take to the global, then you are effectively also taking it to new market, correct? So you have to take that into consideration if you want to develop that understanding of how this potentially be applied to many contexts. So if you really think of it, uh, this is, of course, my hypothesis, anecdotal evidences. There is no research output to show that this is the case. My experience in Indian industries, Indian companies operates in quadrant A and B. It is because to operate in quadrant C and D, you need a significant amount of innovations and R&D. And unfortunately, Indian corporates do not invest a large quantity of money in R&D. Just to give you some anecdotal data, uh, if you really look at the IT industry, right? And IT industry is extremely profitable industry, generates significant amount of profit, and they also don't need capital for growth. So most of the profits are distributed to the shareholders. So, however, if you really think of it, if they don't want to distribute that to the shareholders, they could potentially invest that money to do something which is uh, little innovative, little disruptive. Just to give you a context, Indian IT industries, on an average, spends 1% of net profit in R&D. The global average is 14%. So think of it. If you don't invest in R&D, are you expecting that you will actually create something new and disruptive? Unless you create something new and disruptive, you would not survive the international markets. So same way, if you our best industry for disruption is pharmaceutical industries, and pharmaceutical industry spends around approximately 6% on R&D. However, the global average is 17%. So, and if you really think of it, just there are some basic data. If you take top 10 companies by profit, and those are non-finance companies, that means SBI, SDFC Bank, Axis Bank, they're excluded. Those top 10 companies by profit spends 2% of their profit in R&D. And if you take countries like US, Japan, Germany, China, they spend close to 29 to 55% of their profit in R&D. So if our Indian companies do not invest in creating disruptions, then we will be operating in a quadrant which is more following Adam Smith, and we will ignore JB says. And JB says in modern businesses are the one who are actually creating something for the future. So so if you really visualize that we want to become a manufacturing hub, and we want to have a current account surplus, and then we need to migrate to quadrant C and D, and maybe the innovation fund, research fund will help us, but the corporate capital has to flow into those two quadrant for us to migrate into a product country where we actually produce something. But good part is at least now I can visualize two in quadrant D from India. For example, our UPI and maybe our quick commerce will be a quadrant D. So quick commerce has not worked in many places. For there are very cultural, geographical regions exist, but at this point of time, I am seeing two UPI and quick commerce, which is can be placed in quadrant D. So now, keeping this context of two factors of production, labor and capital, and fitting this into two foundational economic philosophy, as Adam Smith and JB says, though we are currently operating in the domain of Adam Smith, it is because we have a large quantity of unmet demand, but our aspiration should be moving to quadrant C and D. So now I'll try to bring the how we can take this further into different categories of enterprises. Uh, this is going to be a little provocative, but I thought I must share because that's what I feel. If you really look at neoclassical economic thought, which is the currently the most dominant economic thought, and how do this neoclassical economic thought get into corporate boardrooms? So if you really look at neoclassical thought, it's obsessed about measuring. Everything has to be measured, and it is focused on efficiency. and and efficiency, if I add efficiency when, then it is not something which you can visual efficiency when, but we are talking about efficiency. Most of the efficiencies in corporate context are measured now, uh, at this point of time. And but efficiency also can be viewed as intertemporal, over time. Correct? I am not efficient now, but I can be efficient later. So but when we are visualizing corporate and they are applying the neoclassical thought, which are I want to measure everything. And what is the context I am measuring? I am measuring one aspect, that's shareholders. So I want to maximize shareholders wealth, because that's what the managers serve for. And classic agency problem, manager versus owner. And we are one of those countries where a lot of owners are family businesses, and the dominant principle is efficiency. And if you apply those dominant principles, then you would like to continuously uh, maximize shareholders' wealth. And if I can have the liberty to say that if you treat an organization as a machine, and that machine needs to extract maximum from the given resources. And that's what foundation economics course will teach. Resources are scarce, use it optimally, and then maximize the return. So, but if you have a different view where you can also visualize enterprises are living being, because if you look at the regular legal structures, the private limited companies have its life of own. So they are not, I may promote a company, but I'm different from the company. So if you say that this is also a living being and which needs to be endured over a long period of time. And the foundation here is the shareholder impatient uh, to the needs of other stakeholders? So if you really think of it as that living being, and that living being has to be managed, endured, taken to the next level, and that's how organization progress. But if you do efficiency focused, I'm not saying that you should not focus on efficiency. I'm saying that if efficiency is the only driving force, then you will actually take out all other factors of production, and then you will stretch it to that level. When you will have a significant attrition of employees, the organization will be having difficulties over a long period of time. Anecdotal evidence, research says that average age of the farm is declining. Some may explain this saying that technological disruptions are happening. Yes, technological disruptions, but there are some organizations which are living longer than many others. So the reason could be that they are not necessarily focused on efficiency, the underlying word is in the short term. And the assumption here of the leadership team who is managing this organization, they assume that the shareholders are not patient, they will not give a long rope, they will not give us the time to do the right things and take all stakeholders with us. And rather than maximizing of shareholders interest, we should maximize, rather optimize stakeholders interest. And if you really think of it, current dispensation on corporate social responsibility, sustainability, decarbonization, environment pollution, all issues are originating from corporations' obsession of maximizing shareholders' wealth. So we have to look at optimization of stakeholders' wealth. If you really think of it, there is an interesting thought that came into my mind just now. Economic theory has two foundational assumptions, which was one is human beings are rational. So, and that assumption has been questioned, and we have now a stream of economics called behavioral economics. And now there is another famous assumptions, but very little talked about. It's called free disposability. If you remove that assumption, many theories will not hold. Our conventional microeconomics, 2 banana, 3 apple versus 3 banana, 3 apple, we all preferred 3 apple, 3 bananas, because we assumed that we can throw the 1 apple, and so if we don't want it. But if you really think of it, the present day's problem is actually predisposability. It's like it's my pollution, so I can throw away my pollutant to river, sea, uh, city water bodies, because it is predisposability. So now the question is, unless we visualize economics and found out what is this concept of predisposability and how can we take this into economic theory and concept, how will we address the problem of pollution, problem of corporations, decarbonization, and the whole world is debating how to fund this uh, energy transition, things like that. But those are extremely big topic to discuss. But since we were talking about enterprises and the linkages with economics, I thought I will highlight that assumption. Amarendra, how much time do I have?
No, sir, you don't worry. You go on. I'm enjoying. That's why I'm saying you go on. Yes.
No, no, I want to
But
respect time.
maybe another 15 minutes you can go.
Okay, okay, okay. So, um, so if you really take this aspects into how efficiency, obsession, and what is it doing? It is doing is it is actually substituting labor with capital. And then what is happening, if you really think of it, the revenue growth of a firm is much faster than the number of employees growth. So if you just to, I'll share a anecdotal evidence. Let me uh, share another. This is a data point from SBI's investor presentation. Just have a look at it. I wanted to prove one small point is if you go to any big organization, you can visualize any company you take. Uh, uh, I found this data and just see this. What is happening in 2020? SBI had 250,000 employees, and then they have 232,000. And what is the manpower and productivity? So you can see that as the organization is growing big, number of people working in that organization is shrinking, and productivity of the employees are going, which is a good thing. Which is it's a very good thing that human productivity is increasing. But that also is a challenge for us public policy planners, that big enterprises are not going to create a lot of jobs, because they will substitute labor with capital. And they will maximize shareholders return, and in that process they will not generate enough employable opportunities. The number of employees will grow. I'm not saying they will not grow, but they will not grow at the rate we want them to grow. And in fact, the disruptive technology which is coming, everybody is talking about AI and machine learning. I have no idea how many new jobs will be created in India, and how many new jobs will be displaced in India because of that. That's a big question, and big organization, if they adopt this disruptive technology, and naturally the more labor will be substituted with capital. And if that happens, what will happen? What is the ramifications of that? The ramification is that the enterprises which have access to capital, and enterprises which has a return on equity, which is effectively nothing but how much a equity capital earns, net profit divided by the contribution of shareholders money. And if my cost of debt is lower than my cost of equity and I am debt funding my enterprises, I will increase the share of wealth of shareholders, and then other factors of production's share will continue to decline. If that is what happens, and then what will be the problem of unemployment? The question is, I'm not saying that the efficiency is not good. I'm saying that if we are banking on big corporations and big industries to solve employment problem, that's not going to happen. So then who will do it? It is the new enterprises, people who will go to the C and D quadrant. They are the one, MSME is the one who will solve our employment problem if we focus in right ways. That's the argument I am giving. Productivity of people is good because we know conventional macroeconomics, there are only two sources of growth: population, productivity of the population. So productivity of the population is good. Technology enhances productivity of the people. But the people which we have also need to be meaningfully employed. What are the places we could potentially so that's the question of new enterprises and MSME. Now I have one a paradox to share with you, and those of you who are researcher wants to look at it. There is another paradox. Conventional understanding is that we are an expensive country to do business. That's the popular. Everybody says our electricity bills are high, our interest cost is high, our land costs are high. Every factor of production cost is very good, high. Suppose we assume that that has to be the correct. But if you really think of it, then why is the return on equity of Indian companies are higher than the global peers? If everything is high, all factor productions are expensive, which is doing business, then why is return on shareholders' capital high? I can think of two broad reasons. One is corporations or enterprises are extracting every drop of consumer surplus, and they are getting significant production surplus. So two concept of microeconomics: consumer surplus, production surplus. In that sense, there is another reason. The reason is maybe our domestic industry is protected through tariffs, so that so this is a paradox which now give my quickly given the time I have, what I was trying to say that since the big firms will not solve, it is the smaller firms or new enterprises who will create far more employable opportunity, because the number of employees per unit of capital employed is far higher, and it will continue to be higher. And our public policy discourse should be on how can we facilitate this enterprises development. And we all know that this kind of enterprises faces significant constraints to capital. And there is also one another point I wanted to highlight, that many people, many public policy discourse is confused between entrepreneurship policy and MSME policy, a new enterprise policy versus MSME policy. If you really conceptually think of it, MSME policy is to handle stock, means the companies which are already there. New enterprise policy is talking about the flow, means how many new companies are coming in. So one is to bring the people into the system, the other is actually making sure people don't drop out of the system. In our school days, when we used to have this tank problem, the water coming into the tank and water going out of the tank. So MSME policy should make sure that no water goes out of the tank, means no MSME becomes sick. And uh, entrepreneurship policy and new enterprises policy should be to make sure more water continue to pour into that pond. So the the water level will continue to rise. And I'm assuming that the capacity of the pond is infinity. So, those are distinctly two different public policy requirements. One is a long-term societal, educational, appreciating failure, respecting failure, uh, understanding that I failed not because I'm incompetent, but because there are many things that requires me to be successful. Those are socio-cultural, educational things, which is far more structural in nature rather than giving incentives to MSME, things like that. So these distinctions needs to be taken into consideration. Now I will stop sharing this, because given the time, I just wanted to share two things which we have done research along with my PhD students. One student, which was Swati Panda, who worked on a interesting topic called how do capital to new enterprises come in, how does venture capital, who is effectively providing risk capital, is equity capital to the new enterprises. So we had this is a primary data research where we went to real entrepreneur, real investors who gave money, and we wanted to understand how do they actually work and what kind of process they follow. The conventional understanding, in the dominant understanding from a theoretical point of view, comes from agency problems, and control is the mechanism through which they want to control the new enterprises. But while I was working in corporations and doing risk, conceptually I had a problem then, because risk is effectively have two distinct characteristics. For example, if I am lending to somebody, the first source of risk is his inability to pay. So will he have the ability to pay? The second is his willingness to pay. It's the ability to pay is a well-developed science and easy to estimate, because it's publicly available data. You predict, there are methodological instruments available. You can do that. But doing willingness to pay is not something which is estimable. Uh, Currently, network theory is helping us to understand how does your behavior within your network is affecting your behavior, and can I observe your behavior within the network and then take that behavior into my decision making process, whether are you actually willing to pay. So in some sense, that's something we say called trust. And I'm not talking about trust from a social trust, means if two people are getting married or becoming friends, And I'm not talking about trust here in that context. I'm talking about financial trust. Means I have given money to somebody for his enterprises. I have invested. If that enterprises does well, I will become rich. Things like that. So this is financial trust. And financial trust is not a static concept. It is an intertemporal concept. It's actually transactional trust, and it goes up the time. So to observe that, we actually created a way to find out, and we had an interesting output where we thought that in early stage enterprises, that means when there is hardly any revenue, the idea only exists, there is only founder teams, and enterprise do not have anything to show tangibly. The relationship between VC and entrepreneur is very cooperative. Uh, there is limited agency problem exist. There is a significant amount of trust between both, and there is we can say that the agency problem is because of asymmetry of information, but here it is not asymmetry of information. It is more of a cognitive asymmetry rather than information asymmetry. I visualize it this way, the BC visualize it this way. So that kind of thing we found, where early stage entrepreneurs and late stage entrepreneurs. In late stage entrepreneurs, the agency problems were very high, so they used a very well drafted contract, the control mechanism, to solve the agency problem. But in the early stage enterprises, the agency problem was solved through trust mechanism. So this is something which I thought I will share. We also did something similar things with respect to debt capital also. Shilu, who may be here, we did some work with respect to building social network and social cost of default, and then basically to create a mechanism where we could reduce the collateral need. And but that's something which is at a theoretical stage at this point of time. So I think in the interest of time, I will stop here. So
Thank you so much, sir. I really, thoroughly enjoyed your talk. In fact, I was thinking, like, this is real economics. We no, simply do not remain confined to the equations or the graphs that you are drawing, and you have. In fact, you could no speak so well because of your say rigorous training in economics, as well as no rich experiences in industry. And that's why I was thinking I probably did or we did the right thing by choosing this topic, not actually the typical research paper actually that we are thinking, and it is no less than a rigorous actually research work. So thank you so much. But I will be a little selfish today. Before I open this floor for others to ask questions, I'll ask two questions. uh, so the first one is why are Indian industries or companies not investing too much in R&D? Rather, they prefer to give, say, more return to the investors, and but they don't invest in share market. Sorry, they don't invest in R&D because, as you have told, that the company's life is reducing because of the disruptive change in the technology. And so, what could be the reason? Why is it the typical characteristics of the Indian industry? The second question is uh, for Odisha in particular, or of course, actually, you can say for other states also. Now, many state governments and also the national government, they are trying to say attract many private investment, particularly big private investment, foreign direct investment, but they don't generate much employment. And you have shown the SBI data that their efficiency has improved, but then their employment generation has drastically gone down. In fact, so also in case of many people actually have presented. I think it is Amit Bhadur, who very often reports the data of Tata Industries, or Tata Steel particularly, how their output has gone up by so many times and their employment has gone down by so many times. So that means state governments are trying hard to attract big industries, but they are not going to generate any employment. So, should you or would you advise the state government not to run after big industries, rather try to actually facilitate the small enterprise, which will generate more employment? Because see, if the state government is spending so much of taxpayers' money to attract private investment, and they are giving so much of tax exemption, free land, free water, and free air, like disposability. We're talking about free disposability. We're giving the entire environment actually to them to dispose their resources. So there is a huge cost of such huge in private investment. Rather, in fact, last evening when we were discussing, we are not actually encouraging our own entrepreneurs actually, who could probably contribute more to the revenue, to the employment generation. So these are two questions from my side, but we'll open the floor to others. If I
Yeah.
don't know, you would like to respond to these questions
No,
first?
no, no, it is better because otherwise I'll forget the questions.
Yes, sir. Yes, sir. Okay.
Uh, now, let me answer the easier one, the first one. Okay. See, there are two explanations. One is a simple explanation that there is a huge unmet demand, and mm, and so that unmet demand is being used as a, so I can make large quantity of money. So as a finance professor, I'll say I want to maximize what I call risk adjusted return. Okay, so I know operating in quadrant C and D is very high risk, but the reward also are high. But since I have alternate use of my capital, so I could use that. That is one. The other explanation, which is a complicated explanation, is coming from uh, classic Frank Knight uncertainty. If you see, operating in A and B is risk, and operating in C and D is uncertainty. So, in simplistic, English, if I have to say, risk is something which is the future is continuum of past, and in uncertainty, the future is not continuum of the past. So if you say that my future is not continuum of what it is, so I have no way to visualize what will be the future. So it represents a significant amount of uncertainty. So corporations, especially professionally managed corporations, I'm underlying the word professionally managed corporations, because their incentive is designed in such a way they are rewarded for the short-term performances, not long-term performances. So they would not like to take uncertainty into their decision making process. So they would like to do what is predictable, and then do that. So that is that is another explanation which has been provided. It is to deal with technology frontier. If you, it's like this. If you are competing with somebody where you have no chance of winning, so you will become disheartened. So if you are closer to the technology frontier, you will make an attempt to go to the frontier. But if you are really deep inside into the technology frontier, you are far away from the frontier, you would probably think that reaching that frontier will be very, very. So again, that same concept of uncertainty. Okay, so this requires a deep research and primary level, going and talking to the owner, and if you allow me, I can show you some interesting data. And but you just do one simple thing, picturize what is called share price of Reliance Industries, and then do it a maximum. You will see the share price of Reliance Industries did not go anything for 10 years because they were investing. They are owner managed companies. So owner management companies have far more appetite to take risk and do disruption. So this is also areas of research how it happens. And the second one is a complex question, Amarendra, and it is the answer is not economics. It is actually political economy. So and unfortunately, in conventional economic courses, those subjects are no longer taught that well. Many universities don't even offer that kind of courses. So, but since we are old school, we have taught political economy. So, see, the idea is mm, if you have to visualize, let's take an example of Odisha. Right? If you look at the geographical size of Odisha vis-a-vis, let's say, West Bengal, okay, and West Bengal has almost twice the population, but almost half of our size. So we have large quantity of land, arable land available. Our agricultural cost is cheaper, but if you look at inflation of Odisha is higher than inflation of India. So the question here is there is a tremendous potential with respect to food processing industries, correct? But we are not investing time and energy in that because we want to, because we only visualize iron ore and things like that, correct? And then think of it, let's say if you think of Nalco, most of the Nalco's revenue comes in alumina, not in aluminium, correct? So the value addition is not happening, as the metal processing is not happening. The aluminum goes, steel goes outside, and those will be piped and brought back here. Why can't we have pipes done here? So those it the question here is the size is big. There are people who can be observed in the local areas, uh, and then since we have mining resources, investment will happen, indirect employment will happen. So, but I'm not saying that it is one versus the other. I'm saying it is the bigger firms will not solve the problem. The smaller firms will. So, so that is a far more complex question. And
Okay, okay. Thank you, sir. I think your question answer was very clear. I think we can take other questions. Professor Barendra Kumar Bhai has raised hand. So, sir, you can unmute and ask your question.
So thank you very much for a very illuminating talk. So I enjoyed it. There is a problem. You know, our gross fixed capital formation as percentage to GDP has come down from around 38-39% in 10-11 to around 31-32% now. But our growth rate is sustained at a higher level, or we are growing at a higher rate. Definitely, this is because of productivity. So, productivity has definitely increased, although some industries might have suffered. Average on an average, if you see productivity numbers are not very credible. Definitely, there is some improvement in productivity somewhere that is contributing to high rate of growth. Now, the issue is MSME. Mostly, the MSMEs are producing the existing product, mostly, except a few startup and some new companies or some which are coming up now. Most of the MSMEs, they are producing the existing product where the productivity is not there, innovation is not there. So how can we grow at a higher rate? That is the problem.
sir, this coming to There is definitely a productivity improvement. And there is another explanation. If I can apply my uh, practitioner's hat, if you look at our composition of GDP is moving towards service,
Exactly.
and service is not capital intensive. So if my composition is moving from 50% to 60%, and that composition is not capital intensive, I can also have a higher growth rate. That is possible. Uh, and am I making sense, sir?
Yeah, that is correct. Definitely, our industries are not doing well. Agriculture productivity is low. Services sector is contributing, no doubt about it.
And services is not capital intensive.
Not
That
capital
in
intensive,
comparison to manufacturing.
but probably some innovation is taking place there. Probably JBC is working there.
Yes, yes,
Like
JV
this,
says.
and that is contributing towards this, GDP. Whether this, MSME, which we argue that it is employment intensive, can be able to do that.
Uh, Sir, let me see. There are many products which is efficient in producing at a smaller scale. Uh, of course, if we, let's say, uh, we have mostly viewed and looked at American model to understand our economic progress. But there are other alternate models like developed countries like Italy, Germany, who has a very, very unique small industry setup where people produce niche. They take one niche and they specialize on that niche. If you take a specific type of niche and take that niche to the deepest level, then you will can operate at a smaller scale and still be, because if you see most of the export that is happening in Germany is actually by small industries, smaller companies. Same way, even in India, MSMEs also contribute a significant portion of export. Even actually, bigger firms are not exporting that much. Rather, small firms are exporting. So, sir, we have to find out new kind of product and services that will be needed. Just give you one perspective, sir, since you asked, and I teach entrepreneurship. See, in next if we look at demography science, that we will all live longer by 3 years in every decade.
Yeah.
And if you see 1947, what was our rate, life expectancy versus what is it now? Every decade we will grow, we will live 3-4 years more. Now think of it, the present generation, my children's generation, they will live 90 to 100 years. So now the big problem, let's say geriatric, we will have a significant amount of people who would be above 65. Already around 60 million is already there. And if you see and look at the demography side and what kind of need this segment of the people will have, and who will serve or who will meet their need, if you, sir, visualize it in some sense, there are enough possibilities possible. Same way, now the world is moving to health and wellness, superfood. So you have to find out if you operate in Adam Smith quadrant, then it will not happen, sir. You have to come to JB says quadrant, then it will happen, sir.
Okay.
I don't know, sir, whether I answered your question or not.
Actually, that is actually happening. See, at one point of time, employment for the sake of employment was not sustainable. Now we have to have gainful employment, for which what we require is we have to improve productivity of the labor by reforming the education system, R&D. These two things are very much necessary. If our people are not employable, then problem lies in education system. So we have to think in terms of revamping the education, increase productivity, so that they will be employable in the new setup. Even if it is services sector, doesn't matter, but they should be highly productive. Then only you can think of a new product, quadrant D. That is what is necessary. Thank you. Thank you.
Okay. Thank you so much, sir. Are there any other questions? Okay. If there are no other questions, so we may invite Professor Sukant Misra, the youngest son of Professor Baidyanath Misra, to share his, a few words with us, probably about the talk or of the memories of Professor Baidyanath Misra or anything. Yeah, over to you, sir.
Okay, well, first of all, Professor Das, thank you very much for sharing your, I would call, disruptive thoughts. That was very enlightening. I thoroughly enjoyed it. It's past my office hours, but I'm still here at home listening to your
Thank you, sir.
No problem. Well, I wanted to thank you all, particularly the Orissa Economics Association, for celebrating my father, Dr. Baidyanath Misra, in such a meaningful way. I know he was thoroughly engaged with the association. As Amarendra has already said, he was associated with the association for about 50 years, almost half of his living life. When we were growing up, we witnessed his passion for the Orissa Economics Association. He used to spend hours together talking about, thinking about ways to bring to light economic knowledge assimilated and generated by Oriya economists. I know he, until his last days, he used to spend hours talking to people from the association, planning for the annual meeting or some journals coming out, ideas that could bring more recognition of Oriya economists. So we thank you again for your love and respect for our father. Of course, today is his birthday. We're all thinking about him, missing him, but we're all happy that he lived a long and meaningful life. And I'm glad that you all are taking this important time to celebrate him. Thank you very much.
Thank you so much, sir, for joining with us from USA.